Hey all, thanks for joining us for this coverage of Micron. What you're about to see is, I'm making it sound really exciting. What you're about to see
It is exciting. It totally is.
is an excerpt from what our semi-insiders got last week. We're going to show you a brief presentation on Micron, and we're building out a growing library of tools over at chipstockinvestor.com for your analysis of companies like Micron. And if you haven't seen it yet, make sure you go back and watch this video right here. We'll link it in the video regarding how CSI invests. We went through our investment thesis checklist with Micron, and I think that's an important place to start and help you understand what we're talking about right now.
So let's recap here briefly from last week. Our investment thesis checklist that we were working on with Micron with some notes on the company. There's some questions here about the length of the sales cycle. Historically, memory is a pretty short sales cycle that can last upwards of 2 to 3 years. We're still within that window of a short sales cycle. So we could go either way on this. We could say the sales cycle is short or long. So you could check it green, we could check it red. It's still up in the air. As far as hierarchy in the electronics manufacturing and semiconductor manufacturing supply chain, we would say this is still more of a niche advantage company. But the caveat to this is, of course, they have two competitors in South Korea, SK Hynix and Samsung, that can produce, depending on the generation of product, for all intents and purposes, the same thing with some minor differences. So that could also go either way, debatable. One thing we do need to check green, though, at this point is the first quantitative metric, industry average or better revenue growth, even if you include the last decade plus of basically boom-bust cycles for Micron and suboptimal revenue growth. Once you throw in the last few quarters of growth, we're starting to look at even a 10-year average revenue growth rate that is pretty good, especially when you factor in the guidance for Q4 of the current fiscal year, which ends later this summer.
Yeah, so you can see on the very right-hand side of this chart, this is the most recent quarter, over 41 billion in revenue and operating profit over 33 billion. Guidance for Q4 fiscal 2026, which is Q3 calendar 2026, is 50 billion in revenue and an implied operating income of over 41 billion.
This meme we made a few months ago with CEO Sanjay Mehrotra, still very much valid. The internet can thank us for that one. I've seen it pop up, other people's version of it, including some pretty famous analysis houses. Anyways, let's talk about this specific point from the video last week, because it's important not just to talk about structural change of a business in fuzzy terms, but if you're trying to really pin down a thesis in a business and build conviction, you can't just talk about everything that's going right. You have to get more granular. Let's talk about the revenue more specifically, because this is still very much a transactional type of revenue with some guarantees built in now. So we're not going to call this something silly like a software-like subscription-based business model.
Don't be ridiculous.
Don't be ridiculous. I am ridiculous.
That is ridiculous. But let's break down the transactional side of this, because something has changed, at least through the end of this decade, through the end of 2030. With these take or pay strategic customer agreements, or SCAs. Casey, what is a take or pay agreement?
That's an excellent question. It's actually just what it sounds like. You either take the agreed upon product, or if you decide you want to pull the rug out from under Micron, you still have to pay for the product that you agreed to take.
And this was really throwing Wall Street analysts for a loop. Obviously, Micron is not going to go through each of its 16 SCAs that it has now signed and go through every detail on it. But they did offer, I thought, a lot of detail that they could disclose.
And I should clarify, the payment that would need to be made if a customer decides they do not want to take the product is a pre-agreed minimum sum of money. So they wouldn't pay for the exact product cost, but there is a pre-agreed minimum payment that a customer would have to pay, basically a cancellation charge.
And this is important because this is where a lot of the semiconductor industry got hosed when the chip shortage, especially the analog chip shortage and memory to an extent as well, in 2022 and 23, a lot of industrial and automotive customers in particular were double ordering, triple booking orders, trying to get allocated supply. And then when the chip shortage flipped from undersupply to oversupply in end of 2022 through mid 2023, 2024, they all canceled. And many of them were in financial duress. They were able to wiggle their way out of those guaranteed cancellation charges. So Micron needs to avoid that from happening again. So instead, they're saying, hey, let's just actually ink a long-term supply agreement. That way, we're not building capacity you decide later on you don't need, and we get hosed. And in the interim, you're getting the supply that you do actually need right now, and we can allocate it in an orderly fashion along with our other customers. So let's go through a few of these details that Marotra and CFO Murphy talked about on the call.
Here's another little detail that we should keep in mind. Management said that the agreements have a 5-year term from calendar 2026 through the end of calendar year 2030.
And those would probably be the hyperscalers and Nvidia on behalf of the hyperscalers.
Yeah, they said automotive, on the other hand, generally has a 3-year term.
Yeah, imagine if those terrible capital allocators in the big automakers and old industrial businesses had exercised their position of strength and maybe signed an agreement or held to an agreement or even acquired a distressed semiconductor business during the last bear market, instead of freaking out when they didn't have supply and then freaking out again when they had too much supply. This is why the semiconductor industry is now 20% and probably headed higher than that of the S&P 500. Electronics manufacturing, much better capital allocators benefiting from a secular growth trend, and a lot of older industrial businesses have just been really terrible capital allocators for a long time, and they continue to shoot themselves and their shareholders in the foot. Just saying. Anyways, back to Micron.
Thanks for coming to the TED Talks. Let's focus now on the bottom paragraph there. It gives us a few more details on some of these SCAs. There is a ceiling price for existing products. This is a key item that we want to highlight. This is existing products. This doesn't mean some of the future tech that Micron has been working on.
HBM4, HBM5.
Exactly.
Probably not included.
So some of these agreements are at the current market price, and then there's also a floor price in terms of the agreements. That's the minimum amount that a customer would have to pay. And then several of the SCAs are fixed prices or have no price bands associated with them. So there's no floor or ceiling, and they're subject to market conditions. When all of these SCAs are executed, either with fixed price or price ceilings and price bands at the current market prices, this is expected to be about 40% of Micron's revenue. So over the next 5 years, this could be up to 40% of their revenue.
Yeah. A couple more final details here before we move on to a recent historical example of how this take or pay agreement would work, where the customer, even if they say, hey, the 3 or 5 year commitment we made, sorry, we have to cancel it, keep the money we put on deposit with you. Here's this last detail. The majority of these SCAs basically are worth $100 billion over the next 3 to 5 years. Let's call that backlog. Now the famous and often hated backlog that a lot of companies are now providing now that manufacturing is all the rage during this bull market. And to date, a number of these SCAs, again, I would say probably the hyperscalers and Nvidia on behalf of the hyperscalers, include a cash deposit up front that if there's a cancellation in the future, Micron is probably going to keep most or all of that cash deposit as sort of a guarantee so that they can have some fallback and say, we built these fabs, now you're canceling on us and we're left holding the bag. At least they get some recourse for that. We're going to see cash deposits of about $22 billion in the next couple of quarters show up on the balance sheet. It'll be listed as a liability because it's a cash deposit made for work that Micron has not done yet. But what that means is it's basically a guarantee that Micron will be able to realize as revenue at some point in the future by delivering memory products to its customers or getting to keep most of that payment if there's a cancellation from the customer. So this is a pretty good deal for Micron. And the reason why they're able to structure this as a take or pay agreement is because the other two leading memory chip makers, Samsung and SK Hynix, are also sold out of capacity. And so a customer probably doesn't want to cancel the order outright because it's not like they can go to one of the other two suppliers and get capacity allocated to them. They're also sold out. So Micron able to use that. This is industry dynamic to its benefit and get these very favorable take or pay agreements.
It seems like Micron learned a lot from the chip shortage and then the chip oversupply. And I'm not going to call this a structural shift because I don't even know what that means. It's way too vague, but we do see some really positive changes to how Micron is functioning.
And let's talk about a historical example. So a lot of the analog chip makers, for various reasons, especially competitive reasons, there's a lot of new competition coming out of Asia and Southeast Asia during the period of chip shortage and then oversupply from 2021 to 2023. But here's an example of a company that was able to use long-term agreements to its benefit successfully. Albemarle. Yes, I can hear the objections to this right now. The lithium is not the same thing as memory. I get it. Lithium is more upstream, therefore the price is going to be even more volatile than market prices. But let's just walk through this though, because it will help you understand both what will go right for Micron, but also what will eventually cause some volatility, at the very least to the downside, in the stock price. So back in 2021, 2022, Albemarle also signed these long-term agreements that they're actually still selling to their customers. Even though electric vehicle demand has obviously slowed down significantly the last 2 years, that's being made up for with energy storage, big battery packs getting plugged into the grid. And as a result of that, even through the bear market, Albemarle's volume of shipments actually continued to increase. Pretty incredible, right? Now, of course, the market price of lithium tanked after 2022. So the volume of shipments did not save them from cratering revenue and profit margins. That's an important point.
Yeah, absolutely. In fact, Albemarle could have gone bankrupt.
There is a very easy scenario here where things went slightly worse than they did, and this company is being hacked up for parts and sold off to competitors.
Yeah, you can see that free cash flow drop deeply into the negative. Total revenue, operating profit, not so great there in 2024 and in 2025. But because of those long-term agreements, not exactly take or pay agreements, not the same thing, because of those long-term agreements, Albemarle was able to stay in business and have growing sales, even though the revenue was struggling. And because of this, here's the stock price.
There's been some recent volatility in recent months, but Albemarle back on the mend. Rather than going bankrupt, yes, it was ugly the last 12 to 24 months, but things definitely looking up again for the company, despite a pretty hellacious period. And so by comparison, I think it's pretty healthy to consider a couple of different alternative outcomes. One, okay, maybe Micron revenue keeps going up and stays up over the next 3 to 5 years, and profitability also stays elevated. That is not conviction, though. That's hope. You have to consider another scenario where, because the hyperscalers especially are agreeing to pay high prices today and commit some cash to Micron, they're guaranteeing more supply will come online over the next 3 to 5 years. And as a result, Micron's revenue and definitely their profit margins will at the very least moderate. 80, almost 90% gross margins and 70% plus operating margin is just not sustainable. It would be great for Micron if that continued, but it's not a sustainable situation for the industry and the economy overall. So actually, thank the hyperscalers for signing some of these agreements and making sure that more supply will come online and that these profit margins will moderate at some point. Definitely not this year, maybe not even next year, who knows? But maybe by 2028, 2029, some of these margins moderate. And as a result, you should also factor in a scenario where Micron stock runs into some volatility because the market has overshot on this expectation that these margins can just stay this way for the indefinite future.
Yeah, what's the best way to ensure that you're going to have more supply in the future? You have to pay higher prices now, and that's exactly what's happening with Micron, SK Hynix, Samsung. And going through this, I can't help but think this is kind of what happened with Nvidia. And a lot of folks out there wondering why Nvidia's stock is not doing much. I think there could potentially be a time in the not so distant future that could be exactly what happens with Micron stock. That's not an unbelievable scenario, is it?
Yeah, over even a year or two, which is still a pretty short-term period, stock prices can decouple from the actual financial report. That's essentially what's happened with Nvidia, as you said, still killing it financially. Stock prices underperformed relative to other semiconductor companies like, for example, Micron and the memory chips, optical networking this year, just really on a tear. But interesting times. But that's the lesson, though. I think that bears repeating what you just said. This is a seeming paradox, especially if you've ever taken economics before. And apparently it's a lesson that a lot of governments around the world never figured out. This putting caps in place on price actually can sustain a less than ideal situation. The best way to fix a supply and demand imbalance that is leading to unsustainably high prices and one company or just a few companies getting outsized profits for the indefinite future is to just simply pay the high price right now so that competition is incentivized to come in. The current incumbents are incentivized to increase their supply and will allow for some margin compression in the future. Just pay the price up front, take it on the chin, and you set the table for, over the course of the next 2 to 3 years, this situation moderating. Good for Micron right now, good for the memory makers right now, good for them also long term, but even better for the industry and the economy overall over the longer term if we just eat it up front and allow these guys to have their not 15 minutes of fame, but you know what I mean? This crazy 70–80% profitability period.
Make sure you have hit that subscribe button and don't miss a video. And check us out over at chipstockinvestor.com. As I mentioned earlier, growing library of tools for investors to analyze businesses like CSI. Check it out. We'll see you over there. Take care, everybody. And don't forget to watch this Micron video right here.
Where we were apparently wrong?